you don't need to know the semantics of it, but more so know that it's spread over 5 years unless you elect this Section 179 code. And so you can purchase those computers at year end, those copiers, the things of that nature, and get immediate deduction.
Yeah, that sounds really good. So, you talked a little bit about purchases. Go a little deeper with me on, kind of broaden the scope on what would be covered and what would not be covered. And I'm going to probably ask a couple of dumb questions along the way here as far as, and you may be dealing with it later, but you remember when I built my building and there was certain things that I could take off immediately because of certain rules. Does that apply?
That does apply, but we will be discussing that later. That is called cost segregation. Now, on that note, realize when we talk about this cost segregation later, we'll be referring back to the Section 179 and also the 168 that we'll talk about later. Those items are applicable when it comes to 179. So let's talk about a couple of those items and the way to define those. The IRS classes by their rules and regulations various categories of assets. A computer, the majority of equipment are classed as 5-year assets. So that's a class. So Section 179 applies to 3, 5, and 7-year assets. Now, furniture and fixtures, those are 7-year assets. So you say, okay, well, what about the others? What's in those classes that this doesn't apply to? Well, that would be your 10, your 15, your 27.5 year, and really all the way to your 39-year property. And so you say, well, I can't get my investment back for 39 years. That's absolutely correct on some of the properties. And so that's the reason you want to look at this 179. One additional caveat that the listeners might be interested in is the fact that you don't necessarily have to pay for the asset prior to placing it in service and receiving the deduction. So let's go back to we used a copier as an example. So you purchase that copier. That copier is provided by BIS Office Systems and installed for you, and they install it on December the 28th. And you say, but I'm going to lease that copier, and I'm going to finance that lease over a 36-month term. True, but you have the entire lease, and that could be considered what's referred to as a capital lease. And that capital lease allows you to deduct that entire amount over one day, which is the December 28th, i.e., we are all in the 2018 tax year, and so when we purchase that, we deduct the full amount. Same apply to a server, etc. And so it gives you that immediate deduction, which gives you that immediate value as opposed to spreading it out over a number of years.
Yes, and I have several clients that take advantage of that, where we'll basically lease a piece of equipment and put it in towards the end of the year. They get to take the full deduction and then get to pay for it over the next 2, 3, 5 years, whatever. So that's good. All right. So in the sake of time, I'm gonna jump on. Let's move on. Let's talk about the Section 168, advanced depreciation.
What I'd really like to make sure everybody understands what the 168K advanced depreciation is, how it is different than the Section 179. Section 168K is often referred to as bonus depreciation. Bonus, not that you get to deduct more than 100% of the value, but really it's an immediate deduction, and the immediate deduction is 100% of the cost of eligible property. And so you look at that and say, well, isn't that what we just talked about?
Yeah, that's right. Yeah.
Yes, somewhat, but it's different, and it's different in classes. That's where it's different. So you make the 168K bonus deduction with some additional 10 and 15-year property classes. Technically, it's all the way up to 20-year classes. The difference is we don't see a lot of 20-year class assets, where we do see a lot of 10 and 15-year class assets. So I'll give you an example. An example would be your landscaping out front. You install some new landscaping and it's a 15-year asset and you spent $15,000 on it. In normal tax code, that means you're going to spread that $15,000 deduction over 15 years. This allows you to deduct that once again with the immediate deduction. And so then the question becomes, well, why don't I use this for all of it? Well, because you can't. Different classes call for different tax code sections. The Section 179 is limited to the number of assets. The Section 168, or not number of assets, but the value, total value of the number of assets. The 168K it's unlimited. You could buy $4 million worth of assets and still be able to deduct them. Historically, when the 168 was applicable, it would be for used assets. With the new Tax Cuts and Jobs Act that came into effect at the beginning of this year, now used assets are applicable. And Section 179, it gets limited. Here's how it gets limited, Philip. So let's say that your business made $100,000, and at the end of the year, you purchased total assets throughout the year of $150,000, and you wanted me to deduct those, and they all fall in that 3, 5, and 7-year window. I can deduct those, but only to the extent of the income. So in our example, I used $100,000. Well, I can eliminate your income, but I can't take a loss. And what that means is I can't create a net operating loss. There's nothing I can do with that other 50 other than let it sit there and do nothing. Yeah. With advanced or bonus depreciation, I can actually take a net loss, carry it back, and get some money back from last year maybe. So there's some distinct advantages between the two different sections.
I like it. I really do. I've already got an idea for myself on that. So that's great. That's really, really, really good stuff. So let's move on. Let's talk about what is the difference between, prepayment of ordinary expenses. What is this that we're dealing with here? Which expenses are going to qualify, and, why isn't everybody using it, I guess, would be another.
Well, when you look at Sure. And when you look at prepayment of ordinary and necessary expenses, a lot of people at year end, they want to sit down and they're looking at, where am I at tax-wise? Where am I at net income-wise? And how much tax am I going to owe? Because we want to plan for the year. Now, the biggest, what you refer to as silver bullets out there, are always the purchases. The first two we went over. That's every CPA in the nation. That's the first go-to item. But sometimes they aren't needed. So let's say, for instance, they walk in and they say, well, I'll just go purchase a vehicle. Do you need a vehicle? Well, a lot of times the answer is no. So we start looking for other ways to reduce taxes. So I'm going to use an example to show you prepayment of ordinary and necessary expenses. The only item this does not apply to is inventory. So let's just use the example of, I have a service industry in the construction field. And so I'm an electrical contractor. I want to reduce my taxes, and I'm sitting there at union, but I really don't need any of these assets that my CPA keeps telling me to buy. But I don't want to buy them because I'm going to have to pay for them long term. So I decide I'm going to pay my utility bill. That's $1,000 a month. I'm going to pay that for the next 6 months. I'm going to go ahead and write that check out right now in December. Send it on, because I'm a cash basis taxpayer. I can deduct that right now. Likewise, some other examples would be, in addition to utilities, telephone, utility supplies. Now, when I say that, utility supplies, you said, but you said inventory. Well, that is determined by whether you truly have inventory or whether you do not. A lot of electrical contractors don't necessarily have inventory. Philip, you in BIS, you don't necessarily have inventory. You don't have it sitting on the shelf with SKU numbers. All of your inventory is custom. And what I mean by that is it's sold on a cash basis. Client calls you and he says, I need a new server. Well, there's 80 different thousand servers out there that they could need, and you pare it down to the one they need. You don't have it sitting on a shelf. You order that. You customize it for them. That's not inventory in your cash basis. So therefore, a client who has these ordinary and necessary expenses that are cash basis can prepay all of these items. And once again, when you add them all up, let's say they spend that same $100,000 in advance in December instead of buying a vehicle. Well, now all of a sudden, when are they going to receive? They receive their deduction in December 2018, but when are they going to receive their return on investment? Because that's the key that we're after. What's our return on our investment? Want a vehicle? It's the life of the vehicle. In utilities, my example, for 6 months, you received your return. You started receiving it in January because when you received that $1,000 bill, you didn't have to write a check for it. You've already deducted it. So you just have big credit on your account. The only caveat I would say to this, Philip, is you don't want to pay a bill for something that a salesman maybe could manipulate on you. And what I mean by that is if you were paying, for instance, your insurance, if your insurance is set and it goes up 2% every year, not a problem. But let's say you have to negotiate that every year and it's a 10 to 15 to 25% change. Well, you don't want to prepay that because they know they have your business and they can raise the rates on you. But remember, I talked about government. I talked about not-for-profit electrical industry. I talked about maybe a utility supply company that you use, and it's a standard price every time. It's 2%, over whatever the commercial rate is. Those you can lock in, and that's where some real savings and investment and return on investment comes into play.
Yeah, after our consultation last year, our year-end consultation, this is one of the things that we took advantage of, and it was really sweet last year because of, we were anticipating, Trump getting the tax, whatever, I forget the name of the law, but basically where taxes were going to be reduced, and we paid out about $200,000 a head, which really put us in a position of, that would have been like 30 grand worth of savings, right? At 15 points.
At 15 points, that's right. But a lot of people are in a substantially higher tax bracket than that. And so, and yours is different than that as well.
Well, I was talking about from the tax break itself that Trump gave on money. Didn't he?
Yeah,
tax?
That's right. And what people have to understand is by lowering that tax rate this year, we took advantage of a high tax year. So this is not a temporary deduction or reduction in taxes. This was a permanent reduction. What I mean by that is it was not a one-time event that we do every year. Are you really just, deferring it and you're going to have to pay it next year? Well, we did have to pay it next year, but guess what? Paid it at a much reduced rate.
That's right.
And when you pay it at a much reduced rate, keeps money in your pocket. It's not just a timing difference, it's a permanent difference.
Absolutely. All right, that's really, really good stuff.
Hey, Philip, on that too, there is current talk in Congress of an additional reduction in 2019 that they are currently working on. I fully expect that you will see that come probably, I would guess, within a month after the election cycle, that is going to be focused on the middle income taxpayers, which would be primarily your clients and my clients. And so this would be absolutely applicable should they pass that law. It will be absolutely applicable just like it was last year. So we're looking forward to that tax reduction.
Yeah, that's music to my ears. All right, let's move.
Hey guys, before we move forward, we had a question come in. Okay. Would acquisition of the copiers in advance be considered a non-inventory prepayment of ordinary expenses?
It would, but keep in mind at that point you're talking about an asset. You're not talking about an ordinary and necessary business expense. Now it qualifies as ordinary and necessary. That's not what I'm indicating. What I am indicating is a month-to-month utility bill is not considered an asset. It's just considered an expense. However, a copy or a prepayment would absolutely fall into that asset category. But the key is on assets. In-service date, that's the key. So you swipe that credit card on December the 28th, or you sign that contract, you want to make them deliver that. And there's some technicalities there on freight. Is it freight on board? Is it freight from shipping? There's all that FOB in there, but best policy is you have them install it, you sign a contract by December the 31st, regardless of if you've made payment, that's your deduction. You're in good shape, even though you haven't made payment.
Good stuff. It's really a great question too. So let's move on to this. How do we convert our charitable contributions into advertising? I know that there was some law changes about charitable contributions, them being more limited. Am I correct in that, Jamie?
Yeah. And the terminology that you're hearing a lot is them being more limited. And this is what we're really driving at. And this is one of those things that it is not in the public domain right now. All the CPAs know about it. We're trying to get the word out, but the larger publications, Wall Street Journal, Washington Post, they haven't picked up on it because people aren't focused on individual taxes right now. It's going to happen in January and it's going to be too late. So here's what you need to know. The standard deduction when you did your 2017 taxes in 2018 was $12,800. The majority of your listeners and my clients are above $12,800 and for itemized deductions. Okay, so they receive the greater of their itemized deductions. You say, okay, that's confusing. What's itemized deductions? Well, it's your charitable contributions, your mortgage interest, your property taxes. It deals with your medical, but those can be limited. Okay, all of that to say it's primarily those. Now, there's a lot of others that it is, but those are the main ones that people focus on. Well, you can't change a lot of them, quote, manipulate them, but you can, you're charitable. You say, well, why do I want to? The new tax law changed the standard to $24,000. So let's say, Philip, that last year your itemized deductions were $23,800. I just did this example this week because I had a client call in and ask. $23,800 in 2017. Then that means you took the higher. You took $23,800 total. But now we roll over to 2018. Well, where are we setting? Well, all of a sudden, the new standard deduction is $24,000. So you're saying, well, I didn't get to write off my charitable contributions. Well, you got to the extent that they're above itemized, but yours just happened to not be above itemized. You were $23,800 in 2017, and you're $23,800 in 2018. So now you didn't have an extra deduction. So what do we do about that? For business owners, we want to look at advertising in lieu of charitable contributions. Because if I can convert that charitable contribution to advertising, it's now 100% deductible with no limitations. And so how do we do that?
Yeah, that's what I want to know. Because
sure.
Pretty much, I mean, if I say it's a church and I'm going to donate some money to them as a business, or some type of charity that I'm giving money to, and usually don't they give me, I'll put your name on a banner or something like that. So is that how you convert it, or you tell me?
That's exactly right. A lot of times you're looking at these civic organizations and they're doing great work in our community, but they're doing a lot of fundraisers and they're doing a lot of sponsorships, and they're trying to even think of small little league baseball teams. So they have this booster club put together, and they want to send you that charitable receipt. That charitable receipt's good, but you know what I really want? I want my name of my business on a banner or a sign or a uniform or a small advertising banner on the 14th tee of the golf tournament, because I just supported that local organization just like I wanted to. But the difference is I had a small form of advertising come out of it, and therefore not only did I receive an advertising deduction instead of charitable, but I made sure I coded it to advertising on my books so that my CPA didn't have any question about it whatsoever. They automatically looked at it and they said, wow, he converted his charitable to advertising. He now receives 100% deduction, as opposed to it being completely limited and them not even telling you about it.
Yeah, that's very smart. I mean, again, you're spending the same money, you're getting all the same good, but you're getting to save and keep some more of your own money. That's a no-brainer, as I would class it. Well, cool.
That's exactly right.
All right, let's move on and let's talk about how to deduct more than your vehicle cost.
So we're gonna pick this up in two sections in our presentation. One is the vehicle cost, and one is later on, 2 slides later on. But we're going to pair these together because they work together. Everybody knows that if they go and purchase a vehicle for, let's just say, $25,000, that's probably not realistic in today's market.
Yeah.
More like $35,000 or $40,000. That they get to deduct something. Typically, you hear of depreciation. Okay. Now, a couple slides later, we're going to look at something other than depreciation, but we have to address it here first. And why is that? It's because you have to understand where your vehicle falls in the realm of size of vehicle and in the realm of the size of your business. So a vehicle, for most of your clients and mine, they have 5 or less vehicles. And if they have 5 or less vehicles, they are not considered a fleet. There is different tax rules for fleet vehicles than non-fleet vehicles, and the default for most clients, for most CPAs, is to automatically default to the fleet rules because they're easier. However, they're not always the most beneficial, and we're going to see that. So the key that I want you, as we move forward in our presentation, the key that I want you to see here, remember how to deduct more than your vehicle cost is to assess, do I have fleet vehicles or do I not? And sometimes you can pare that down in other ways. Maybe you have a vehicle that's personal use vehicle more than it is business use. Maybe I want to reimburse that employee or that business owner for a portion of that vehicle, because if I do, I get to have 5 or fewer. Now I'm in the non-fleet vehicle rules, which are way, way more advantageous than the large company fleet vehicles. And we'll show an example of that in a couple of slides.
Okay, that's really good information, and I'm feeling pretty good, buddy. You done helped me out, and I think every one of these areas so far. So you're earning your keep as an accountant. So I appreciate it. All right, let's talk about this entity selection. This I don't even know what that means. You're talking about like an LLC, an S corp, or C corp?
That's exactly what I'm talking about. And what I hear so often is people come in and they're wanting to start a company, and they want to talk about, they actually don't want to talk about any selection. They don't know. They just know they want to start a company. And of course, we hand walk them through the process. But here, I'm not necessarily focused on the new client, because a lot of times that's not your clients. That's not your audience you're talking to. I want to talk about the existing businesses that are currently buying from you. So, well, how does entity selection apply then? Well, it applies the same way it did the day before you started your business. You can convert entities An LLC can convert to an S corp. An S corp can convert to a C corp. A C corp can convert to an S. There's all of these items that can be converted. Now, they might not be converted legally. They might only be converted for tax purposes. However, they absolutely could be important to convert. So, do you remember that slide a few slides ago? We're talking about prepayment of ordinary and necessary business expenses.
Yes.
When we were talking about that, I was talking about a cash basis taxpayer. Cash basis meaning that when you write out the check and send it, it's deductible. Remember, we could prepay. Well, there's also accrual-based taxpayers. Accrual-based means that the invoice, when you receive it, it's a deduction. Or when you send an invoice, it's income. So no cash changed hands, but you have to record it. Well, maybe we want to do some modifications of accrual to cash. The new tax law, it did not allow us to do that near as readily before, but the new tax law allows us to. And we're going to see a lot of modifications this year in particular between cash and accrual and also between entity selection. How does that apply? Because the new tax law has completely changed over 50% probably of what business owners knew about the tax code. Right. The reason to have an S corp might be more or less profound in your particular situation than it was 1 year ago. The reason to have a C corp has dramatically increased. You hadn't heard of a C corp talked about in a long time, probably 20 years.
That's right.
But now you're going to see them coming back. There's also more reasons to talk about LLCs than ever with the new tax law. So it's not something that is a one-time discussion with your CPA. It's something that you want to look at this year in particular and say, do I have the right entity? And if not, what's the best way to convert it for the least amount of money so that I can save taxes?
Yeah, absolutely. That, and it really, I mean, I think, as long as we're in this, with Trump in there, it seems like he's really mixing things up a lot. So maybe even over the next few years, we may see a lot of changes that, if taken advantage of, could be really pro-business, I'm hoping.
I believe that is correct, and I believe you'll continue to see that. Like I mentioned, the new law that's coming out for the middle income class, I fully believe that that's going to affect the businesses quite a bit. And in doing so, it's going to make the entity selection even more so important. And there are just tremendous amount of semantics that go into the entity selection. So it's different for everybody. So I can't give just the grand example out there, but for some it could save $1,000. For some it could save $80,000, $100,000. And so you're talking about real change and real money.
Yeah, absolutely. Well, that's cool stuff there, man. That's exciting. I like hearing real change and real money. All right, so let's talk about hiring your kids. What's that look like?
Well, the kid on the PowerPoint is probably a little young, but hiring your kids is something that was popular probably years and years ago, 20, 25 years ago. Not so much today, but it's just because a lot of people don't want to deal with their child working in their business and the semantics of getting them set up. However, the cost reduction can be extreme. Here's an example. You hire your child and you really do have to have them work, okay? It is applicable that they need to actually work. But let's just say that you hire your child for $4,000 or $5,000. So we'll use $5,000 as an example. Your tax rate is not yours, Philip, but let's just say that our average listener here is 25% for federal. Well, if you tack on another 5% for Alabama, now you're at 30. But what a lot of people don't realize is they're also paying self-employment tax. That's that Social Security and Medicare and all that good tax. Well, if you're the business owner and you're paying the employee and employer piece of that, that's 15.3%.
Yep.
So now you're at 45.3% in our example. So we're going to hire the child that's, 16. Let's make the example a little more extreme. Can a 14-year-old work? Sure, a 14-year-old can absolutely work. So we hire that child, and we want that child to come in during the summer, and they're going to do things. They're going to organize. They may do janitor work. They may do filing. They may work on the computers because, hey, we know that kids are technology proficient nowadays. So they do work for you. You pay them $5,000 in our example. You just saved at that point $2,300 worth of tax, and you had your child work. You taught your child good work ethic. Your child now has money that they can spend because guess what? You were going to pay for it anyway, that child, for their ordinary. Now they need to buy their McDonald's meal when you're out and about and they want something, or they need to put their gas in their vehicle as a 16-year-old. That's what you want them to do anyway. The only difference is the same money that you would have used, you've now converted into a deduction and saved $2,200. You say, well, yeah, but isn't the child going to pay taxes? No. They're going to be in a small enough tax bracket, typically 0 tax bracket, that they're not even going to have a filing requirement, meaning they won't have to file a tax return. They received a $5,000 W-2. You say, yeah, but they still have to pay Social Security, so that's not right. Actually, they don't. They're not required to pay Social Security and Medicare for specific children related to you within the confines and personal of your business, etc. So once we meet all those rules, and your children would, all of a sudden we're saving $2,200 on money that we were spending anyway.
Yep, that's one more than I'm doing. So I'm pretty much hitting all these. So I'm feeling good right now. I'm feeling really good, and that is really one of the smartest things, because it lights up a lot of boxes, a lot of things. You teach your kids how to about working in a business. You teach them how to manage the money. You don't have to give them money because they have their own, so they learn a little bit about budgeting, and you get a tax break. That is a win-win-win-win. There's a lot of wins in that bucket. So that's really good stuff. All right, so we're going to jump back, and we're going to go a little bit more, I guess, off of kind of the fleet vehicle thing, and talking about vehicles. And one thing that I think is just funny is that I hear so many people, and you could probably tell me, Jamie, because you work with a lot of people in this area, but they're like, yeah, let the company buy your car. That's like one of the things. Well, you don't buy your car, the company does. And of course, nobody connects the fact that, well, I own the company, so ultimately I'm buying the car. But talk to me about mileage in lieu of depreciation.
Yeah, and this gets back to deducting more than your vehicle's worth. So we all know that clients walk in, a lot of clients walk in at the end of the year, and the very first thing they do is they see what their taxes could be in April. It scares them, and they immediately want to run out and buy a $70,000 F-250. And it makes me just want to scream. I tell them, that if they need it, that's one thing. But if not, let's don't do that. Let's look at some other items. So I'm going to use an example of a salesman. Okay, now keep in mind we're talking about non-fleet vehicles. That means 5 or less in the company, and you happen to be a salesman for the company yourself. So we'll talk about the shareholder's vehicle, but it could be the employee's vehicle as well. They buy a nice vehicle. We're going to go ahead and buy a brand new vehicle, a $20,000 Honda Civic. And you say you can't get Honda Civics for $20,000. You can get them all day long for $20,000. A Honda Civic base model, $20,000, and they're going to get some great gas mileage, probably 35 miles to the gallon. And I'm not partial to Honda Civics. It could be a Hyundai. It could be any vehicle that is low cost, high mileage, safe vehicle. Well, this is salesmen, so they're going to run a lot of miles. So we know that they deducted in our example earlier, depreciation, over 5 years, they were able to deduct $20,000 for that vehicle. Plus, they can deduct their fuel and they can deduct their maintenance. So let's just say that in 5 years, they put on 150,000 miles on that vehicle. Now, that's not the life of the vehicle. Obviously, it can go longer, but a lot of businesses want to upgrade by that time. So if they did that at 35 miles a gallon, then they did 4,285 gallons in that time frame. And if you just use nice round figures of $2.50, you're going to come up with 10,715 worth of fuel. So we're at about 30,000. We'll add another 5,000 for repairs and maintenance. We're at 35,000 that we were able to deduct for that vehicle. That's what it actually cost us. Now, here's the kicker. For non-fleet vehicles, 5 or less, we don't want to do that. We don't want to put them on the depreciation schedule. We want to just memo them on there, and we want to take mileage. That 150,000, you're able, or your CPA is able, at the end of the year to convert the actual expenses to mileage expenses. And you say, well, but then I got to keep up with mileage and all that. Hey, Philip, if it's a 100% vehicle and you started out at 5,000 miles at the beginning of the year on your odometer and you're 25 now, then you went 20. Okay, I can, I can look at that. That's not hard. If there's some personal use, we'll subtract that. But the 150,000 on a 100% business use vehicle, the rate for the IRS reimbursement rate is, and it changes year to year, but let's just use the 0.535, 0.545. You're going to get to deduct, in that case, $80,250 or more over the life of the vehicle. So instead of deducting 35, we're deducting 80,000.
Yeah, huge.
Now that's a pretty extreme example. I get it, but that's $45,000 additional deduction that we didn't have, and that's large. That's really large.
It is, absolutely. Again, I'm in the club. I'm doing that, so I'm feeling good so far. All right, let's talk about a simple retirement plan. What's the benefits of that? Now, let's just talk about. All I hear about 401ks. So you're going to have to kind of, let's talk about the differences there when you answer that.
Well, the 401k, what you end up with, and they're absolutely the most popular of the retirement vehicles. However, with a 401k comes administrative cost. I don't mean by your internal accountant or bookkeeper working on as far as administrative cost. I mean, you're having to pay a fiduciary. You're having to pay for a separate tax return on that. And you say, well, I don't remember a tax return. You wouldn't, because the actual retirement company does the tax return. But I bet you'll remember that bill you received for about $2,000 each year.
Yep.
And what ends up happening is the fiduciary, that's the one that holds all the money, they're having to account for that pot of money, that, the client's pot of money. So we'll use BIS. If BIS has, 30 employees and they're putting money into this pot, somebody has to account not only for what's in the pot, but they have to account for what the different pieces of the pot are and how it's invested differently, so that when somebody leaves, they can give them their piece of the pot. Well, in a simple retirement plan, each and every person has their own account, their own investment account. So Jamie Hardy has one, Phillip Long has one with their name on it. And the company actually sends the money directly to that account. You say, well, why don't we just do it with the 401k? Because the cost burden is so much lower. You can have this simple retirement plan account and you can send money to it, and you're talking about probably $50 a year administrative fees versus $2,000.
Wow.
And you say, well, why don't more companies do it? Really, the marketing of the 401k community. And here's why. The federal government, when it passed the regulations to allow for 401k, it pushed it hard, extremely hard. It marketed it well. Likewise, the administrators market it well. Why would they want to market an account for $50 if they can market an account for $2,000? They don't. Now, there are some benefits to a 401k. In a simple retirement plan, you can contribute up to $15,500, depending on your age, maybe $16,500. In a 401k, maybe up to $50,000. However, I'm willing to bet a bunch of your listeners are contributing $15,500 or less. And if they're doing that, there's really no reason to get above that and go into a 401k, because you're costing yourself $2,500, approximately, for fiduciary fees. And so this just allows you to do it a lot easier.
Yeah. Can employers do a match in a simple retirement plan?
Absolutely. So with a 401k, they have a bunch of variations of that match. It's customized to them. I can match 50% of the first 4%, 25% of the first 8%. They can come in the plan. They can't be vested until after 2 or 3 years in the plan. With a simple plan, they're 100% vested in day one, so that's good for the employee. And number 2 is it's an automatic 3% match so 100% of the first 3%. So if Jamie Hardy's an employee of BIS, he contributes his 3%, and Phillip matches that 3%. That is the only match that you can do. You can't do 50% of the first 8. Now, in the first year, there is something where you can do 2%, and then graduate to 3 the next year. But in reality, most people just start off at 3 and leave it at 3, and then it never changes. But the paperwork, it's 1 page long, Phillip, as opposed to filling out a whole customized plan.
Yeah, and something that I think that's important for business owners a lot. I mean, we, of course, we're in a 401k. We set that up 20 years ago, but I really felt like it was important for me. A lot of people don't understand money. And, a lot of younger people, they don't get it. And I always, we wanted to do it, and we set ours up where it really is pro employee, and we have a really good match. But, this is something that a small company could do with 4 or 5 employees. It'd be really easy, teaches them how to save, and it puts something away for the future. And it's a way you can, hopefully, it's another benefit. I'm giving you 3%. I'm giving, for every dollar you put in, I'm matching 3% of it, or dollar for dollar up to 3% match. So that's good stuff.
Well, that's right. And you do then have a retirement plan. And keep in mind, if you start a simple plan, there is nothing that requires you to stay there. If you start one and then in year 10 you say, hey, I want to move up, I want to contribute more than $15,500, start a 401k. Not a problem. We just convert it and we start the 401k. It's so simple. But until it's beneficial for both the employer and the employee, why not pay $50 until such time that it does make sense to have that 401k?
That's right. And really, it gets down, there's a lot of options. I mean, everything that you've talked about so far, there's a lot of options and there's a lot of alternatives. And the problem is that most people don't know these things, and they don't, you don't know what you don't know, and you go along, really, with blinders on, and you're leaving a lot of money on the table that is ultimately your money. And I believe that we're all to be good stewards of what's been given us, and part of that is educating ourselves. So that's really kind of lends myself to where we are right now is, really what should you do next? And, I encourage you guys, this is something that I'm not going to make a penny off of. This is something that I want to help my clients out, that's the thing. But a lot of times people, they come to these things and I watch and they don't actually take advantage of it. And I know personally that I have saved over these past 18, 19 years. There's no telling how much money I've saved by really just being smart, or really letting Jamie be smart for me. So I encourage everybody to jump on that. I will have one. I'm gonna say one thing. Right now, what's going on in the market for us is there's a lot of Windows 7 machines and servers that are out there that need to get replaced. I'll put in one quick plug for my purchasing person, Jamie Moyer. She would be happy to help you as far as like if you want to get those purchases in this year, and even if you want to do that Section 179 that we talked about, where you could lease that equipment and write it all off in this year, depending upon where your books are. You got to get with your accountant. But I really am trying to take care of people and get those old assets out that are into lifing, and so that. And then also, Jamie has been.
Philip, on that note. Mm-hmm. On that note, let me mention that computer note too. It's not just I hear the Windows 7 and I agree with you, but the difference in efficiency between a new computer and one that's 5 years old is dramatic. And it's not just because the technology is better. While that is absolutely true, that computer's got 5 years worth of information that's clogging it up. Think of a 5-year vehicle. Does it run the same that it did the day you bought it? Probably not. It's got little cracks on it. Just had to have their tires replaced. It might squeak a little bit here and there. New computer doesn't. And I'm telling you, the efficiency difference is dramatic.
It is, and you're a guy that really appreciates that because you sit in front of your computer. Actually, one of my most popular blogs that is out there in our blog on our site is it talks about calculating the cost of downtime, and I encompass what I call the hidden downtime, which is basically waiting on your computer. That's downtime. You're not able to work. And if you just figure a $30,000 a year employee waiting on their computer 15 minutes a day, that's about $1,200 a year. And then there's all this other stuff that goes into that with like culture. The culture goes down in environments with crappy networks. I've seen it. I've been doing this a long time. It is absolutely the truth. People, they hate their computers, and they just kind of sets them off, I guess, and they it does affect the culture. So that's kind of another. I class that as hidden downtime, the culture shock, and also the actual waiting on the computer. Google did a study. The happy employees are 38% more productive than unhappy employees. So, well, Jamie has been so gracious to get on here and do this with me, and I certainly do appreciate it. And I mean, no joke, this is real life here, and I believe that I have done every one of those 8 things. We haven't converted the charitable stuff. I think we're doing that this year because we've already talked about it, but that's because of the way that the laws have changed. But it's good stuff, guys, and it really does save. And Jamie was gracious. I told him he needs to give something away for me or to me for this, and he's going to give away a 30-minute tax consultation that really needs to happen, I guess, pretty quick. I hope you got some calendar spots open. And how would somebody take advantage of that, Jamie?
That's correct. I do have some calendar spots open. Anybody could email me or call, and I believe my contact information will be up at the end. They can email me directly. They don't have to go through secretary or administrative assistant. My apologies. They do not have to go through that. They can email me directly, and I will send them a calendar link to my calendar. And let's bump that tax consultation up to about an hour, I think, because, Philip, I think what it'll allow them to do is get into their situation, specific situation more, and feel like I've helped them, as opposed to walking away and thinking, man, there's some really good ideas, but I don't know how to implement them. And so we'll do that for an hour. And if they'll just send me an email, tell me that they watched the seminar, and I'll be glad to do it.
All right. And we got here, I know you're going to be tied up, so we got here, they need to jump on this basically within the next couple of weeks, because you're going to be working on year end. So if you guys want to take advantage of that, jump on, and you can email jhardy@hardybrock.com, and you can take advantage of that hour. And I think that really is probably what separates you from a lot of guys, is that you take the time to understand the situation, so that you can really dig in, because you kind of have to do what I call a discovery. You got to figure out what's going on. And I think a lot of times accountants, rightfully so, I mean, I know you guys are busy, but they don't spend the time to really, with that kind of, I think what I like about what you've done for me is that your thought is you're trying to take care of me, because I don't know much about all that. And so if you guys want to take advantage of that, hit Jamie up, or you can contact Christy or myself, and we'll get you connected.
Hey, Philip, we had some questions come in.
Okay, thank you.
Okay, if I have a vehicle that I elected Section 179 full depreciation on in the year it was placed in service 2013, can I now switch that vehicle to mileage method?
Unfortunately not. Now, let me expound on that for just a minute. You cannot, because it is elected either depreciation or mileage at the time that you purchase the vehicle. So whichever you elect, you must stay with. That said, keep in mind, less than a 5 fleet vehicle, we can have 2 with mileage, 3 with depreciation. We get to pick and choose. So we can do the best of both worlds. We just can't change between the same vehicle.
And you can actually let it run a year to see which way is the better option, correct?
That's absolutely right. And you think about it, if you buy it in, let's say, January one year, and you don't file taxes and you extend until the next year in September, you're really filing your taxes a year and a half in arrears from when you bought it. You know exactly which way to choose then.
That's exactly like that's a perfect example of what we did. Is we usually roll out our fleet it's not a fleet, it's 5 or under, and we put them under different companies to keep us so we meet that criteria. But that's exactly what we did, not knowing, who was going to, how it was going to play out. So we just, kept that decision open until we had some data to support which way was going to go better. Again, all under the direction of Mr. Hardy here. So he really hooked us up on that, and that was it was really a very smart decision. And we bought the same kind of thing. We bought Honda Fits, and I think they were like 18.5, and I'll make back a lot of my money on a lot of these vehicles within 18 months. So I'll have that vehicle paid for doing mileage. So really does make a difference how you book this expense. All right. Well, guess we're right at time, guys. 1:58. I don't see any more questions now. I'd like to really thank Jamie, thank Christy for putting all this on, and also her staff for doing all they do. And as always, we appreciate you guys so much, and we're going to try to do more things, not just computer-related stuff, more business things that really help the business community. This community has been so good to our company, to me personally. I really want to focus on giving back all I can. So keep an eye out. We'll do a webinar every month, a seminar every quarter at this rate that we're doing. And we really put out a lot of good white papers too, I think. So if you're not on our email chain, book up, and we'll speak to you soon. Thank you so much, and have a great afternoon.